Today we are going to analyze one of my favorite companies in the world, which is Apple. I have been a software engineer for different Apple products for 15 years. Their products are great, their softwares are great, their ecosystem is great, their users love them, they have a great moat, and overall they are a great company. And right now they are the most valuable company in the world. I'm an owner of Apple, but more on that later. Today we have a special guest, Baby Aslas, which came directly from Australia. Two of my good friends who are visiting us right now brought him to me. He is gonna be the official mascot of the channel. So if you want to name him, subscribe to the channel and comment below. So shout out to Rehan and Ali Reza. Me and Baby Aslas love you. So without further ado, let's get this video started. Hello and welcome. Like always, we are gonna start with revenue. And as we can see, Apple has been growing their revenue every year. Let's take a look at their revenue breakdown. Last year, they had a revenue of almost 400 billion, and almost half of it is from selling iPhones, which they have been growing steadily. They have other hardwares that they are growing too, but the part that I'm really excited about is the service part. Let's take a closer look at that one. We can see their services are growing very fast. They have tripled their revenue from services in the past 6 years. And the reason that I'm excited about that is service business has higher operating margins, which means they can turn more of their revenue into earning. Apple is pretty good at turning revenue to earning on the hardware side too, but on the services they can do more. So I'm really excited about seeing the growth they have on the services. And I would say this will continue to grow since they just entered the financial market. They have an Apple Card, they have a saving account, they have Apple TV Plus, they have an App Store which is probably the best monopoly in the world. There are 1 billion Apple devices in the world and all of them need to use App Store. They have a good control over their ecosystem and they are able to monetize it very well. They are one of the most innovative companies in the world. They have brought us Mac, iPods, iPhone, Apple Watch, and now recently Apple Vision Pro, which is right now a new category, but probably later on we will find some use cases for it. Apple is pretty good at creating needs that users don't know they have. We didn't know we want multi-touch screens, but now we can't live without them. My bet is it's gonna be the same thing with Apple Vision Pro. In 5 years, it's gonna be a smaller, better, faster, and we can't live without it. Apple is pretty good at destroying their own old devices because if they don't do it themselves, their competitors will do it for them. So they always innovate and make their old devices obsolete with new devices of their own. And my bet is they're gonna continue doing this for the decades to come. Some people are really worried about the fact that half of their revenue is from iPhones and iPhone is saturated so they can't sell more of it. But those people could be wrong because every year 1.5 billion smartphones are being sold and only 200 million of them are iPhones. So Apple still has a long runway to go. I won't say they can achieve it, but at least they have the potential to do so. So the revenue just from the iPhone has the potential to reach $1 trillion. Now let's continue with the equity. So as we can see, Apple was increasing their equity until 2017, but it has started going down. And why is that? So this was part of the management decision that they should use the equity that they have in the company and buy back some shares. Since they didn't need the cash, it made sense to return it to the stockholders. But let's take a closer look at their balance sheet. Right now they have 332 billion of assets and 270 billion of liabilities, which leaves them with 62 billion of equity when they have 110 billion of debt. So let's take a closer look at the asset side. As you can see, something like a third of their asset is long-term investment. They don't have that much property, plant and equipment right now, and they have a massive cash position of 55 billion. So they can pay half of their debt down using their cash. But let's take a look at their cash flow. So each year they have 100 billion free cash flow, so they can easily pay all their debt down in a year. Since they are a money printing machine, the the management is not worried about lack of equity in the business. So they use all the money they create and invest it in the business and buy back shares to return it to the shareholders, which I love. So next, let's look at ROIC. And we can see they have a return of invested capital of something around 40%. They are working very efficiently. They don't need so much investment to be able to create more earnings, which is great. We love these type of businesses. Let's take a look at their net margin. Their net margin is sitting somewhere around 25%, which is great. We love that. And they have been growing their earnings very fast from 1 billion to 100 billion in a couple of years. Let's take a closer look at their income statement. They have almost doubled their revenue in the past 6 years. They have a gross margin of something around 50%, which is great, an operating margin of something around 30%. They have doubled their revenue and they have doubled their net income, which is great. It shows that they are predictable. They are growing steadily. We love to own a company which is predictable. Next up, we have free cash flow margin, which is around 25%. So this is really good. They are able to turn their earning into free cash flow, and they have been growing their free cash flow steadily too. They have lots of debt, but that's understandable. They have lots of free cash flow to be able to pay down their debt if they see fit. Their dividend payout ratio, which is the amount of dividend they are paying compared to the earning they are making, is somewhere around 20%, which is great. It means their dividend is sustainable. They have been growing their dividends consistently, and they can do so in the upcoming years. The other thing that you all know I love is share buybacks, and Apple's share outstanding has been going down steadily. I don't need to buy more Apple stocks, and every year I will own a bigger slice of the pie, which is great. So overall, Apple seems like a great business. They have a good balance sheet. They are growing steadily. They have a good monopoly. They have a good user base. They have good user satisfaction. They have a great ecosystem that incentivizes users to stay with them. So they will always have loyal customers. So we are going to keep Apple in our watch list. But we are going to do something new on this video. If you remember, I am an Apple shareholder. So I'm going to share with you my holding. Here we have the Apple's stock price, and the blue lines represent when and how many stocks and for what price I've bought Apple. In the past couple of months, you can see it has gone high. People are really excited about AI, and when people are really excited, they move stock prices higher, and I don't like that. So I haven't been buying Apple since December last year. I will just wait for something to change and Apple would be available at a better price and buy it then. Until then, I would just sit, relax, and wait for the opportunity to present itself. Thank you for watching. If you have any questions, please comment below. I'm happy to answer them. Please consider liking the video for the YouTube algorithm. Subscribe to the channel. Have a great rest of the day, and see you on the next one.